Hello everyone, hope you all are doing well. Welcome to Diplomat's Desk. I am your host Meet Shah. So to deep dive in India's economy in 2025 where policy meets reality. Today we are not just talking about numbers here, we are talking about your money, your loans, your groceries in your future. So the RBI has cut the repo rate to 5.25%. What does that really mean? Let's break it down clearly, deeply and with real world impact. In early 2025, the repo rate was 6.75%, a level held since 2023 to fight inflations. By December 2025, after four strategic cuts, it dropped to 5.25 percentage. Why? Because inflation cooled dramatically from 4.8% in FY25 to just 1.55% in July 2025, the lowest nearly in decade. The RBI saw an opportunity, stimulate growth without risking price stability. So it cut rates not at all at once but in steps. In February 6.75% to 6.25, then in April 6.25 to 6%, then in June 6 to 5.5%, and finally in December 5.5 to 5.25%. This was not panic, it was precision policy. Let's talk real money here. A 50 lakh home loan at 8.5% over 20 years meant an EMI of 43,000 rupee approx. After the rate dropped to 7.75%, the EMI fell to 39,000 approx. So it's 3,000 rupees approximately monthly saving. That's a yearly of 44,000 rupees, enough for a family holiday, a new car down payment, or your children's tuition. So for new borrowers, even better. Banks now offer rates below 8%, boosting home affordability. But here's the catch, not all loan benefit equally. If your loan is linked to RLLR, that is repo linked lending rates, the cut hits your EMI immediately. If it's on MCLR, you might wait 6 to 12 months, showing how loan structure matters. Refinancing from MCLR to RLLR could save 10 to 15 lakh over 20 years, even after fees. So in 2023, inflation was 5.4 percentage. Your 10,000 bought less. So in 2025, 1.5% 1.55% inflation, and food prices actually fell. Yes, deflation in food: tomatoes from 100 to 20, onions from 80 to 15 per kg, ginger down 38%, cauliflower down 26%. This isn't theory; it's a real relief. An average household now spends 1,500 to 2,000 rupees less per month on groceries. That's actually 18,000 to 24,000 savings annually. Money that can go to health, education, or savings. But it's not all good news here. Core inflation, healthcare, education, and rent stayed at 4.2 to 4.6%. So while food is cheap, urban living costs are still rising. So real purchasing power is up. Wages grew 6 to 7%, outpacing inflation. Small businesses are the backbone of India, and in 2025 they got a boost. A 20 lakh business loan at 11% that costs 22,000 per month. After the repo rate cut, rate drops to 9.5%, saving 30,000 a year. That's money used to buy machinery, hire workers, or expand. Sectors like textile, food processing, and logistics saw a 15 to 20% rise in new loan demands. But transmission was not equal. Public sector banks passed cuts faster, like Bank of Baroda, Indian banks. Private banks delayed, protecting their net interest margins. Still, credit flow improved and investment picked up. Lower repo rate helped borrower but hurt savers. A 20 lakh FD at 7.2% in 2023 earned a 1.44 lakhs per year. By late 2025, rate drops to 6.1%. Income fell to 1.22 lakhs, a 22,000 annual loss. For retirees relying on FD, this is a real pain. Banks' NIMs narrowed, they earn less when lending rates fall faster than the deposit rates. And small savings schemes like BPF, NSC, SCSS, rates not cut yet but likely in next quarter. So the government buffers this but can't resist forever. So savers face a choice: accept lower returns or take a risk. When the RBI cuts rates in December 2025, Sensex jumped 800 points. Investors cheered cheaper credit. Corporate bonds yields fell. Companies like Reliance raised debt at lower rates. NBFCs like Bajaj Finance saw a loan demand surge, but the rupee dipped to 8.8 per USD. So lower rates made India slightly less attractive for foreign investors. Still, foreign inflows into equities rose. Global investors bet on India's 7.8% GDP growth in Q1 FY26. The RBI upgraded FY26 GDP forecast to 6.8%, up from 6.5%, thanks to strong services, manufacturing, and agriculture. And WPI inflation turned negative, minus 1.21% in October 2025. meaning wholesale prices fail. So, this is deflation at a producer level, good for businesses but a warning if it spreads. The RBI is not just fighting inflation, it's building resilience. Inflation forecast for FY26 2.6% down from 4.8%, GDP growth 6.8%, among the highest globally. Fiscal deficit 4.5% under control, foreign reserves $676 billion, strong buffer. India is no longer reacting to the global shocks, it's managing its destiny. The digital infrastructures like UPI, Aadhaar, ONDC, its global gold standard. And remittances crossed $100 billion, a silent engine of growth. The goal is $7 trillion economy by 2030, developed nation by 2047. And with sound policy, structural reforms, and domestic demand, it's within our reach. So where do we stand? India is in the Goldilocks zone. High growth, low inflation, stable policy. But every decision has trade-offs. Borrowers win, savers lose, urban costs ease, rural income rises. The RBI's job is balance in 2025, it's walking the tightrope well. But you are not a spectator. Every financial decisions to invest, to save, to borrow shapes this story. So stay informed, stay engaged, because when you understand the economy, you gain power. If you found this valuable, like, subscribe, and comment what's your biggest financial challenge in 2025. Until next time, stay sharp, stay smart. Thanks for watching this.